Welcome back to the Daily Crypto Roundup. The market's opening the week on a surprisingly positive note. After a choppy few sessions that left traders jittery and retail sentiment stuck in neutral, the crypto majors are flashing green again. Across the board, risk appetite has picked up just a little, helped by calmer equity markets and the sense that the last correction might finally be finding a floor. Let's start with where prices stand as of now. Bitcoin is trading around $105,625, up roughly 2% on the day. It's back above that psychological $105,000 handle that analysts at Glassnode say has become the new gravity line for the market. Ethereum sits at $3,542, up a touch more than 1%, quietly rebuilding momentum after a rough couple of weeks. BNB is holding just under $985, almost flat, but still near multi-month highs after that massive October rally. Solana is at $166, showing a 2% gain and holding on to most of last week's strength. XRP is trading at $2.55, about 9% higher today. A big move, but an important one given what's coming later in this episode. Dogecoin is at 17.9 cents, basically unchanged. Cardano is 58 cents, up a fraction. Tron just under 29 cents, flat. Avalanche around $18 even. Polygon at 18 cents. Altogether, it's the kind of session that reminds the market that corrections can only last so long before value hunters step in. So what's behind today's uptick? According to Barron's and several trading desks we've looked at, this rebound is a combination of three things: short covering, easing Treasury yields in the US, and early positioning ahead of key inflation data later this week. Bitcoin's resilience around that $104,000 floor turned out to be stronger than expected. Derivatives data show perpetual funding rates flipping positive again, meaning traders are finally willing to pay to stay long rather than head short. That's usually an early sign that sentiment's turning. Ethereum's also quietly reclaiming some market share. It's been stuck under that $3,600 level for most of November, but options desks are seeing a slow rebuild and open interest on the call side. Analysts at K33 Research say that's a sign whales are expecting volatility to come back, not collapse. Still, this isn't euphoria. Daily trading volumes remain muted. But in the words of CoinShares strategist James Butterfill, momentum doesn't start loud, it starts quiet. The key thing is that people are finally buying dips rather than selling them. That's what seems to be happening now. Of course, a rebound doesn't mean everyone's confident. Investment product data this morning show that crypto funds saw another $1.3 billion in outflows last week, the second consecutive week of redemptions. That's a big number. It means that while spot prices are inching higher, institutional capital is still being pulled out of structured vehicles. CoinShares notes that almost all of those outflows came from Bitcoin and Ethereum funds, with Solana once again the exception. It actually saw small inflows, continuing a 7-week streak. Butterfill explained it simply. The selling pressure looks like profit-taking, not a macro rotation. In other words, funds that were overweight after September's rally are locking gains, not dumping crypto altogether. Regionally, the split is interesting. US funds led the outflows, Europe stayed neutral, and Asia saw slight inflows. That supports the idea that this is more about timing than sentiment. Glassnode's on-chain data back that up. Long-term holders are still accumulating. Exchange balances keep dropping, now sitting at the lowest level since 2018. So even as institutional flows look negative on paper, the underlying trend still points to tightening supply, the kind of setup that can flip quickly if macro conditions improve. Reuters reports that several crypto treasury companies are rotating small portions of capital into lesser-known tokens. These are the corporate treasuries of blockchain startups, DAOs, and even a few publicly listed firms that hold digital assets on their balance sheets. With Bitcoin and Ethereum both consolidating, they've started chasing higher yield in smaller ecosystems, things like Chainlink, Near, and Render. On paper, it's diversification. In practice, analysts are calling it a new wave of crypto beta chasing. Chris Weston at Pepperstone told Reuters, "When blue chips stagnate, risk appetite leaks into the fringes. But that's also where liquidity disappears first, when volatility spikes. It's a pattern we've seen before. especially in 2021, when Treasury managers moved into DeFi tokens only to get caught in 70% drawdowns months later. Still, the data show this rotation is small so far, under 3% of total holdings across surveyed companies. But the headline alone has reignited the debate over how much corporate crypto exposure should sit outside the majors. Some see it as bullish, a sign that blockchain projects are maturing and willing to take risk internally. Others worry it's just another echo of speculative behavior returning too soon. Either way, it adds a layer of intrigue to the market structure story. Institutional investors are trimming exposure, while corporates are quietly taking more. That divergence tends to precede volatility. We're going to take a short break. Stay with us. We'll be right back after a quick word from our sponsors.
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
Welcome back. Let's get back to where we left off. The Bank of England dropped a surprise consultation paper this morning proposing a softer regulatory framework for stablecoins. Under the new draft, issuers would be allowed to hold up to 60% of reserves in short-term government debt, rather than demanding near 100% cash coverage. That's a major shift from its earlier, stricter proposals. Deputy Governor Sarah Breeden said the goal is to balance innovation with safety. We recognize that stablecoins are becoming integral to payments. The framework must support their growth while preserving confidence. Markets took this as a green light. The pound-pegged and euro-pegged stablecoins saw small volume spikes immediately after the announcement. Analysts at Bank of America called it a pragmatic pivot that could make the UK a genuine hub for regulated digital settlement assets. It's also a direct response to competition from the US, where lawmakers are close to passing their own stablecoin bill. If the proposal moves forward, we could see the first FCA-approved stablecoin issuers operating out of London as early as mid-2026. The timing matters. As CBDC discussions drag on, regulators seem to be realizing that privately issued stablecoins might do the heavy lifting of digital payments before central banks ever get there. Breeden even acknowledged that overlap. The two can coexist. What matters is standards and interoperability. For the crypto industry, that's as close to an olive branch as it gets. Next, the race toward an XRP spot ETF appears to be accelerating. DTCC, the clearinghouse that underpins most US equity and ETF transactions, quietly listed 5 XRP funds on its website late Sunday. That single move sent social media into overdrive. Analysts at 24/7 Wall Street now put the approval probability around 95% for at least one of those funds to get a green light before year-end. The SEC hasn't confirmed timing, but the infrastructure being put in place suggests it's more a question of when, not if. The significance can't be overstated. An XRP ETF would be the first spot product tied to a token that's actively involved in cross-border payment networks, rather than just functioning as a store of value. That opens the door for a very different kind of institutional demand, from payment processors, not just asset managers. Analyst Eleanor Terrett told Fox Business, "If this launches cleanly, it's not just a victory for Ripple. It's a test case for how the SEC treats utility-based assets going forward. Market reaction so far has been measured. XRP has risen about 9% today. Very healthy but not euphoric. Traders seem to be waiting for confirmation before piling in. Still, derivatives data from CoinGlass show open interest climbing 8% overnight, and that usually hints that big players are quietly positioning. From a technical standpoint, XRP has held that $2.30 support beautifully. If the ETF goes live this month, analysts at Matrixport see $3 as a realistic near-term target, roughly 20% above where we are now. More broadly, it signals a maturing landscape. When spot ETFs first appeared, everyone said only Bitcoin and Ethereum would ever qualify. But the regulatory tide is shifting. Ripple's partial court victory last year, which declared XRP not a security in secondary markets, laid the legal groundwork for this moment. If XRP does get listed, it could force the SEC to revisit its stance on other large-cap altcoins like Cardano and Solana. That's why many analysts are calling this the third wave of ETF approvals, the one that takes crypto from investment asset to financial infrastructure. So where does that leave us heading into the new week? The picture is still mixed, a market finding its footing. Prices are stabilizing, policy is slowly adapting, and capital is still cautious. But for the first time in several weeks, the stories lining up feel constructive rather than defensive. You have monetary regulators easing up, institutional money taking profits rather than fleeing, corporates experimenting with risk again, and the possibility of another ETF headline that could change how the public views crypto entirely. As K33 Research's Torbjørn Bull Jensen put it this morning, markets climb walls of worry, not comfort. The fact we still have big questions is exactly why this rally might actually stick. And that's a fair summary. It's been a long stretch of noise, corrections, and confusion. But sometimes stability itself is the bullish story. Thanks for listening to the Daily Crypto Roundup. Make sure you're following so you don't miss tomorrow's update. We've got more analysis coming on ETF flows and the next macro catalysts as we head into the final weeks of 2025. Drop your thoughts below, hit like, follow, and we'll see you at the top.